Welcome to The Explainer. Today, we are cracking open the vault on one of the most powerful and, let's be honest, mysterious institutions out there, the central bank. We're going to pull back the curtain and really dig into how this one single institution pretty much steers the entire global economy.
So, if I asked you, who really controls the economy? What would you say? Probably the government, right? Or maybe some giant corporations. But there's another player, one that works behind the scenes, with just a staggering amount of power over the actual money in your wallet and what your savings are worth.
All right, so what exactly is a central bank? At its core, it's the institution that manages a country's currency, its money supply, and of course, interest rates. Now, it doesn't serve you and me directly. Think of it as the bank for your bank. And it's also the bank for the government. Its whole job, its core mission, is to keep the entire financial system stable and the economy humming along.
So what's the number one problem a central bank is designed to solve? Well, it's all about taming the natural and often pretty painful rhythm of the economy.
You see, economies tend to swing back and forth between two extremes. On one hand, you've got inflation. That's when the economy is just running too hot, prices are soaring for everything, and the money in your savings account suddenly buys a whole lot less. Then, on the other hand, you've got a recession. That's when things cool down, way down. Businesses start cutting back, jobs are lost, and growth just grinds to a halt. Yet, neither of those is a good time.
So, to stop these wild swings from getting completely out of control, central banks have one main tool in their toolbox. It's the one you're always hearing about on the news. Yep, interest rates.
And here's how it works. The best way to think about interest rates is like the gas and brake pedals for the entire economy. So when inflation is running high, the central bank slams on the brakes. They raise interest rates. That makes borrowing money for things like a car or a house more expensive, which naturally cools down spending. But when a recession hits, they do the opposite. They hit the gas. They lower rates to make borrowing cheaper, encouraging all of us to spend and invest and get the economy moving again. The whole goal is to find that perfect sweet spot, stable prices, and as many people employed as possible.
Okay, but sometimes the problem isn't just a gentle economic swing. Sometimes it's a full-blown, all-out crisis of confidence, a financial panic.
And this really gets to the heart of why panics happen. Our whole financial system, when you boil it down, is just a giant, complex web of promises, of IOUs. But that creates a ton of risk. See, if one big bank or institution fails, it doesn't just disappear. The problem spreads like a virus. It infects other institutions in this massive domino effect of panic. That's what we call financial contagion. And that contagion can lead to the absolute nightmare scenario for any banker, a bank run. That's when some rumor of trouble starts, and suddenly everybody stampedes to the bank at the exact same time, all demanding their money back, right now.
Let's walk through how this happens. On day one, everything's totally fine. The bank has its money out in long-term loans, and it's got enough cash on hand for normal everyday withdrawals. But then, on day two, panic hits. Depositors rush in to pull their money out. The bank starts paying out all its available cash, but it's just not enough. And here's the problem. It can't just sell off those long-term loans overnight to get more cash. So this is the crucial part. The bank is still solvent. It has enough assets to cover its debts eventually, but it's illiquid. It has run out of cash to spend right now. And in a panic, that's a fatal problem.
And this is where the central bank swoops in, basically acting as the ultimate financial firefighter. As the lender of last resort, it can provide emergency cash loans to that bank, the one that's illiquid but still solvent. This calms the panic and stops a single bank's collapse from taking down the entire system.
So, okay, we've seen how central banks handle the normal economic cycles and even full-blown panics. But what happens when the normal tools just aren't enough? Well, after the 2008 financial crisis, the old rulebook got thrown right out the window. Central banks were facing a problem nobody had really seen before.
The problem was this number, 0. They had already slammed that economic gas pedal to the floor. Interest rates were cut all the way down to basically 0, and the economic engine still wasn't starting. This is what's known as the zero lower bound, and it meant their most powerful go-to tool was now completely useless.
So with their main weapon basically holstered, they had no choice but to get creative. They had to invent a whole new arsenal of strategies, which came to be known as unconventional monetary policy.
And some of these unconventional tools were absolute game changers. The most famous one, you've probably heard of it, is quantitative easing, or QE.
The simplest way to think about it is this. The central bank essentially creates new digital money out of thin air and uses it to buy up massive amounts of government bonds from commercial banks. This just floods the financial system with cash, which pushes down long-term interest rates and makes it even cheaper for people and businesses to borrow. And they didn't stop there. They also tried other pretty radical ideas like negative interest rates and something called forward guidance, which is basically the central bank just promising everyone that they'll keep rates low for a really long time. And all of that brings us to today and to the future. Because central banks aren't just reacting to crises anymore. Now they're exploring an innovation that could fundamentally change the very nature of money as we know it.
Think about it. Right now, we really only use two main forms of money. You've got physical cash, the notes and coins in your pocket, which comes directly from the central bank. And then you have bank deposits, the digital numbers in your bank account. That's money that's actually created by your commercial bank. It's a promise from them. But now there might be a third type on the horizon.
It's called a central bank digital currency, or a CBDC for short. Imagine a digital dollar or a digital euro that exists directly on the central bank's own books. What this would mean, functionally, is that it'd be like you having your own personal bank account directly with the Federal Reserve or the European Central Bank. No commercial bank, no middleman needed.
Now, this is a huge potential shift. It raises all sorts of massive questions about privacy, about financial stability, about the future role of commercial banks. So when you look back, from taming booms and busts to fighting off financial panics to now potentially reinventing money itself, the power of the central bank just keeps on growing in ways we're only just starting to wrap our heads around. And that leaves us with one final, really fascinating question to think about for the future.